Good morning, good afternoon, good evening, everybody. My name is Irina Zodro. I head the Partnerships and Stakeholder Engagement Unit at UNDRR, and I have the pleasure to provide an introduction today. As I see that the participants list is still going up in terms of numbers, I would suggest I give one more minute and then we start. Thank you. For the sake of time, I still see some participants joining, but I think it's good to start. So again, good morning, good afternoon, good evening. We have a nice audience from across the world today. So as I said before, my name is Irina Zodro. I head the Partnerships and Stakeholder Engagement Unit at UNDRR, which is leading our engagement with the private and financial sector, including the preparations for this webinar. So it's a real pleasure to welcome all of you to today's event on risk-informed investment for macroeconomic financial stability. As a rather new, yet rapidly emerging topic for both the disaster risk reduction as well as the investment communities, this webinar is the first in a series of 4 webinars examining the case for risk-informed financing and investment over the coming months. The series accompanies the development of a new global study, which UNDRR is undertaking with the support of Acclimatize and a group of financial sector actors to encourage and enable policy and lawmakers, regulators, standard setters, as well as decision makers from both the public and private financial sector to start integrating the full risk spectrum into all financing and investment decisions. As a starting point, today's discussion will look at concrete examples where we can draw lessons from progress to date across the 2030 agenda, including the discussions on climate and development financing in the post-COVID recovery phase. Then identify gaps and explore opportunities to address them. As reflected in the webinar outline, we have been fortunate to secure an impressive lineup of thought leaders in the area of disaster risk reduction, climate change, and sustainable development, and very much look forward to hearing their insights and thoughts on how we can, together, drive a shift towards risk-informed investment and decision-making across all 2030 agenda agreements. So before I hand over to John first, the CEO of Acclimatize, who has kindly agreed to moderate this session, let me quickly go through a few housekeeping items. As you might have already seen, all participants are muted by default, and video has been disabled to conserve bandwidth for our large audience. For today's moderated session, we will use the Zoom Q&A function to take your questions. So please click the Q&A icon from the bottom menu, and please type your questions, including to whom it is directed. Please feel free to do this already during the webinar, not just in the Q&A session. So with this, I would now like to hand over to John to lead us through what I will believe will be no doubt an exciting discussion. John, over to you.
Okay, thank you very much, Rita, and welcome to all the participants who've joined us today, and also to my fellow panelists. Just before I introduce our first keynote speaker, I just wanted to quickly say and pick up on a comment that Irina had made, in that back in 2019, UNDRR commissioned a report to begin to look at the process of how do we fully integrate resilience into investment decision making to sustainable investment, and building on the things like the Sendai framework. That report produced 11 recommendations, and this next piece of work that is underway is really to start to think about, well, how do we take those recommendations and turn them into real tangible actions that actually deliver? So rather than have aspirational, wouldn't it be nice to, let's move them to actions that actually achieve something in the short term, the next 12 months, 18 months, 2 years, because as we all know, for various reasons, the windows to actually undertake work, particularly in terms of climate change, are narrowing dramatically, and we really have to act rather than just keep talking. So that really is the next task that's in hand, and we'll be reporting back through UNDRR on that shortly. But today, we're just going to explore some of the key issues. I'm very pleased to introduce the first speaker. It's Mami Mitsutori, who's the Special Representative of the United Nations Secretary General for Disaster Risk Reduction and head of the United Nations Office for DRR. Prior to joining the UN, Ms. Mitsutori was Executive Director of the Sainsbury Institute for the Study of Japanese Arts and Cultures. But very impressively, before that, she spent 27 years in the Japanese Ministry of Foreign Affairs, Budget Director, Director of the Japan Information and Culture Center, Director of National Security Policy Decision, Director of the United Nations Policy Decision, and so on. So we're very, very pleased and excited to have Mami to just make some opening remarks. So I'm going to hand over to you, Mami, for your comments. Thank you.
Thank you very much, John. Good morning, good afternoon, and good evening to all of you, and welcome to this webinar on risk-informed investment for macroeconomic financial stability. It is indeed exciting to see the large participation in this webinar, reflecting the growing attention by policy, financial, and many other decision makers to integrate climate and disaster risks into financial risk assessments and investment. Now, it seems like the whole world is talking about risk. Naturally, we at the UN Office for Disaster Risk Reduction, we are very encouraged. We know that nothing undermines development like a disaster, and prevention does save lives. But sadly, it took a global disaster like COVID-19 to raise awareness and make risk a topic for everybody. Tragically, we have seen firsthand over the last 8 months how COVID-19 has wreaked havoc globally. We are saddened by this, but nevertheless, we do think that it is entirely possible to reduce risk of all shapes and sizes. But I also have to say right at the outset of today that we are also quite alarmed that even now, in the middle of this turmoil, we still have to loudly advocate for the urgency and primacy of risk reduction. In 2015, member states across the world signed up to the Sendai Framework for Disaster Risk Reduction 2015-2030, and this was the first of the 2030 Global Agenda policy frameworks and set the scene for the Paris Agreement and Sustainable Development Goals. Fundamentally, the Sendai Framework calls to stop trying to manage disasters after they strike us, instead to manage risk before the tragedy takes place. And if we cannot break free from this vicious cycle of disaster, respond, repair, repeat, which costs the world billions of dollars, this is really insanity. And yet we see this insanity played out on the global stage. We are putting lives, livelihoods, and the future on the line virtually every day. And nowhere is this clearer than in our approach to the climate emergency. Though no hard number is available for the total loss or need of investment to address the full spectrum of climate and disaster risk, a study commissioned by Aviva in 2015 found that with runaway climate change, 30% of the net present value of the world's manageable assets would be gone. And yet this amount, I repeat, $43 trillion, does not seem to be enough. Our willful ignorance is undeniable, and we persist in putting off implementing fundamental changes to how we live, how we do business, how we invest, and importantly, how we price risk. Many risks are not recognized, some remain invisible, and inaccurately priced, only until they manifest in the shape of the next disaster. And now we are in the middle of COVID-19, which is undermining sustainable development like nothing. COVID-19 coupled with the climate emergency is demonstrating that we need a clear vision, plans, and a competent, empowered institutions actually, acting on scientific evidence for the public good. We need to urgently start accounting for climate and other disaster risks within all public and private financing and investment. COVID-19 has shown us that the single greatest driver of risk is weak governance and the lack of political commitment to invest in prevention. This is also true for all various runaway disaster risks. You can name it: greenhouse gas emissions, unplanned urbanization, population growth in disaster-prone settings, failure to invest in public health infrastructure, and the list goes on. In a world where economic growth is insatiable, risk has become systemic and embedded in all aspects of what we call progress or growth. And one type of risk can transform very quickly into another one, exposing and exacerbating vulnerabilities. COVID-19, which is a biological hazard in the Sendai framework, has made clear that the precarious systems upon which trade, food, energy, transportation, and social safety nets rely. COVID-19 has also taught us that if we do not strengthen risk governance to tackle existential threats, we are doomed to a Groundhog Day approach to risk, which is repeating over and over the same mistake of the past years, costing lives and damaging the health and economic and social well-being of millions of people. So I believe the moment for radical change has come. And as bleak as it can seem, crises do provide opportunities for bold transformations. So exactly what should we do? We need strategies, financing frameworks, and regulations which address not just single hazards like floods or storms, but those that respond to systemic multi-hazard risk generated by our own activities as human beings. Importantly, we do need to break down the silos between the different agendas and build on and connect progress and evidence to ensure comprehensive climate and disaster risk-informed investment. And please allow me to say that there is no disaster risk reduction without climate action, and there is no climate action without disaster risk reduction. Furthermore, there is no sustainable development if we cannot reduce climate and disaster risk. And we are finally starting to see some progress in the debate of financing disaster risk reduction in addition to the financing climate risk discussion. For example, at the Financing for Development Summit in April this year, member states of the UN agreed on the need to include disaster risk reduction into the so-called integrated national financing frameworks. Disaster risk reduction was also an element at the meeting of ministers of finance convened last week on options to address economic challenges arising from the COVID-19 crisis and beyond. This kind of meeting with the finance ministers was the first ever of its kind at the UN and was convened by the UN Deputy Secretary General and the finance ministers of Canada and Jamaica. So today we have a very rich lineup of wonderful speakers, and I do like to thank you all at the outset as the organizer of the event. Ms. Pietikainen will tell us how the EU is taking the lead in integrating both climate and environmental risk into the discussions on sustainable finance, and what is the crucial role of parliamentarians in risk reduction. Mr. Steve Waygood will share with us lessons learned from the Task Force for Climate-Related Financial Disclosures and ideas for the recently announced International Platform for Climate Finance to put the world on the path for a net zero transition, and how this can be used to push for a comprehensive approach to risk reduction within the financial sector discussion. Our colleague from IMF, Mr. Felix Syntheum, will convince us on the increasing recognition of the need to include physical climate and disaster risk into financial analysis and programming. This event today is the start of an ambitious initiative of our organization with Acclimatize as our partner to develop the economic and financial business case for multi-hazard risk reduction. Changing behaviors and systems will not be easy, and it will require all of us to work closely together and find effective solutions to mobilize greater investment in climate and disaster resilience. But if we do not lift our game today, now, this pandemic will be viewed by our children and generations to come as nothing but a mere warm-up act for the willful destruction of our planet by the climate emergency. Let me close by saying that system change will only be achieved in partnership with the broader financial sector. And this is why I am very much looking forward to the next hour where we can discuss how best to do this. Thank you very much. Steve, over to you.
Okay, thank you very much, Mami, for that excellent introduction. I'm going to introduce my first panel member, which is Sirpa Patinainen. Thank you very much, Sirpa, for joining us. I appreciate Sirpa has some difficulties on the bandwidth, so she's just going to join us by sound only for the moment. Sirpa is a Finnish member of the European Parliament, representing European People's Party in Finland. She's previously Finland's Minister of Environment from 1991 to 95, and a member of the Finnish Parliament from 1983 to 2003. At the European Parliament, she's a member of the Economic and Monetary Affairs Committee and the Women's Rights and Gender Equality Committee, and has been actively involved in a whole series of international delegations. Quite an extensive list here, Sirpa. Importantly, I noticed that back in 2015, Sirpa was the rapporteur of the resolution on circular economy, and has given many speeches about eco-design, waste reduction and policy supporting growth in circular economic practices, which is clearly fairly fundamental to the whole issue of building resilience. So welcome, Sirpa. Thank you for joining us today. I'd like to start off by just asking a little bit of some questions about your work with the European Union. You've been very active clearly on the Capital Market Union Action Plan, EU Green Deal, the Green Deal Investment Plan, and last but not least, the COVID-19 recovery discussions. But I think it really helped the participants and help us understand some of the issues surrounding this and resilience. If you could perhaps share some experience and ideas on what's the role of parliamentarians and the regulators and supervisors, what is your real role in promoting and enhancing a multi-hazard approach to decision making? How can you move that agenda forward and deliver?
Thank you, and I do apologize that I'm voice only, but for some reasons the bandwidth is not very good here to Finland, so it's breaking off if I try to have the video on. And thank you enormously for you, the UNDRR, on organizing this event, and I hope that this is a event in the series of quite a number of events, because I think that we would need to work together with this kind of an audience, both in Europe and globally, to make the change happen. And Steve, John, you asked me what actually politicians can do. And first I would like to start that you have to set the right question, to set the right mindset for politicians. Because if you think that the world is flat, you can't create a concept of a sailing around of it. And this is quite often the thinking that we have economics here, we have financial markets, we have our budgets, we have financial regulation, and that's it, full stop. Then somewhere else you have Sendai agreements, you have risks and disasters and climate change and environment and social development and whatever. And then trying to put them together, it's like, you know, trying to mix the oil and water. But that is not true. We need to understand that we have a basic flaw in our economic and financial regulation. And then when we understand it as a politician, we need to correct it. And this is what the whole program of sustainable finance in the European Union is all about. And I'm very excited that I have had the chance to be part of this sort of a big story on disclosure benchmarks and taxonomy so far. And the next steps is that how you embed it in the public regulation and in corporate reporting. We just need to make in parallel the information on what is the environmental and societal costs of our actions, be it public or private. Are we funding actually non-sustainable developments, like we are with the fossil fuel subsidies at the moment? Are we having our investments embedded, our pension funds, for example, on sunk investments and carbon-rich hazard investments, like Steve Agur is going to talk, I'm sure about it. And are we aware, when we get outraged of the fact how much it would cost to cut CO2 emissions or preserve the biodiversity a bit faster, that the non-action will cost us at least 10 times as much? A bit like the tsunami and the warning networks. And to describe that, you need to embed harmonized and unified indicators, and harmonized from the first shovel to the last breath life cycle analysis methodology of the environmental impact. And this is what the taxonomy takes the first baby steps in the EU. You define what is significant harm that you should not be doing. You define what could be labeled or understood as circular economy friendly, climate friendly, environmental friendly, and in the longer run it needs to be the social, because it is the whole ESG. You have to make companies to report accordingly, because it's a public common good, and we need to know what is the environmental and social foot or handprint. And we need to give that information for investors so that they know how to transfer from unsustainable investments to more sustainable companies, and quite often that is inside the industries. And that matter, and this is the big fight what happens in the EU at the moment, you need to put that on your public funding, on your budgets, on your rescue and recovery funds, what the EU is putting over 1,000 billion at the moment towards the member states. So €0 for fossils, no money for significant harm, and it needs to be the green at certain level, all of the investments, and all the companies getting the money need to have a transition plans how to transform their economies and their actions to sustainable ones. And you need to put that one on all ECB when it estimates where it what kind of a bonds it buys, in credit rating agencies when they rate countries or companies, in Basel, that means in the banking capital requirements. You need to put that in EU budgets, European Investment Bank, and all where the money goes bilaterally with the financial flows. There needs to be the information about what is the environmental balance sheet. Is it getting better? Is it better than something else? Or are we actually subsidizing and using our money or company money to destructive actions? And maybe I have a chance to comment it later, but I'm very excited about the concept of triple materiality to be developed in this context. I hope this helps a bit, but it's a lot of, sorry for talking so long, but it's a lot of work. But if we do not integrate the cost of non-action, we do not integrate the cost of environmental and benefits of ecosystem services, we cannot change our economy, and then we can't change our actions too. And this is a bit a big uphill battle, but I'm convinced it comes out of there. And I have to say that I have benefited greatly from cooperating with you and the UNDRR of developing this cost of non-action and risk concept, and how to integrate the risk on political language, on different kind of impact assessments and calculation and so
on. Thank you, sir. But I've got another question. I'm going to follow up with you in a little bit, but for the moment, just to keep it going, I'm going to turn now to Stephen Waygood. Stephen's the Chief Responsible Investment Officer at Aviva Investors, one of the biggest insurers and investors in the world. Chairs their Environmental and Social Government Senior Leadership Team, member of the Chief Investment Officer's Investment Committee, and Steve founded the Aviva Investors Sustainable Finance Centre for Excellence. He also co-founded the Corporate Human Rights Benchmark, the World Benchmarking Alliance, the UN Sustainable Stock Exchange Initiative, and the Corporate Sustainability Reporting Coalition. Steve was appointed to the European Commission High-Level Expert Group on Sustainable Finance and the UK Green Finance Task Force, and he's currently heavily involved in a really exciting initiative which is called the International Platform for Climate Finance, which perhaps you may mention at some point during the conversation, which is a really exciting initiative and has a lot of links and tags back into this very subject matter we're talking about. So welcome, Stephen. I mean, Aviva's been a leading partner in the development and implementation of the TCFD. It's been incredibly active in that whole issue of socially responsible investment, of thinking about environmental and social governance issues as an investment, a risk management issue, as well as an opportunity management issue. And you've been a very strong supporter and driver of things like understanding the threat of and the impacts of physical risks from climate change. I just wanted to really ask you a question. When you step back and look at all these initiatives, is this approach working? And if not, why not? What are the challenges?
John, thank you. And thank you for the very warm introduction and for the invitation to be here. It's great to be here. I'm also familiar with the Sendai framework, although not steeped in it, not in the same way that people like you are, John, or Rowan Douglas, who's been an inspiration for me and does an enormous amount from Willis Towers Watson, and I'm sure will be known to many of you. Now, Rowan's on the insurance side, and I'm on the investment side at Aviva Investors. Rowan, obviously, at Willis. And he, over the last 5 or 6 years, has kept me abreast of what the Sendai framework involves, how important it is, and how you're trying to reach out to the investment community. And John, you mentioned that I'm on the task force for climate-related financial disclosure. Just in case not everybody on the call is aware of what it is, the TCFD was launched in Paris by Mark Carney. It was launched alongside the Paris Agreement on climate change, but it isn't formally part of it. It's an initiative of the G20 working through the financial the FSB task force on climate-related financial related disclosure, and the Financial Stability Board, which was the phrase that slightly eluded me there, the FSB. They are producing voluntary guidance. And to answer your question directly, is it working? There's a half full reply, glass half full. There's a glass half empty reply, and then there's a bone dry glass response. So let's be half full. Let's be positive to begin with. It is systemic. So it does look through the supply chain of capital. It doesn't just put obligations on the issuers of capital or the issuers of things like equities or debt. It doesn't just ask companies to disclose. It does also ask the intermediaries, particularly the asset managers like me, and the pension schemes like our clients. It asks for a systemic response in a voluntary scenario. Second positive element to it, the scenarios themselves are pretty strong, and the thought that scenario planning should be used systematically by companies and investors to start their thinking on how they govern climate risk. That thought, I think, is a very powerful one. I'm very proud to be part of the task force in suggesting that scenario planning should be more prevalent. You'd be surprised at how little it's been done. And then the framework of the TCFD, it asks for institutions to disclose how they govern these risks, how they manage them, what is it that they've done within their key performance indicators and their internal controls. And I think that approach has been very strong. There's now over 1,500 significant institutions backing that approach. So that must be said to be positive. We've also now got some jurisdictions, and the UK among them, talking about making it mandatory. And the Department for Work and Pensions has issued a consultation on whether pension schemes should be mandatorily required to produce it, pension schemes of a certain size, and also whether companies should be asked to disclose against it on a comply or explain basis. And both of those initiatives we think are very positive. So there's the half full. We've made a lot of progress in the last 5 years in monitoring, measuring, and disclosing some of these risks. However, it is voluntary. It's not always comparable, particularly because the scenarios are much more high level, and they're scenarios for more the world than they are for individual sectors. So I know there's some work being done to build sector-specific scenarios. Another thing I'd say is that if you think about the guidance and what it leads to, the disclosures, they're a better thermometer measuring how risk is actually promulgated through the system, how it's being governed, and perhaps some scenarios about how it's been controlled. But actually the TCFD doesn't turn the heat down in the system at all. It's just better monitoring of risk. And coming as it does from the Financial Stability Board, it is interesting to note that it isn't yet changing any financial stability regulation, whether it's for banks and Basel III or whether it's for insurance companies and Solvency II. So it's very much a kind of art of the possible and what could be done within the geopolitical environment that we find ourselves within. It's not what we need. And that brings me to the bone dry response to your question. What we need is a significant focus on the physical risk. What we have at the moment is a greater focus on transition risk. And I think the greater risk is the risk of not transitioning at all. We do need to get on with the transition, and we're not doing enough to promote that. We're also not seeing the TCFD driving the money that's required to deliver the Paris Agreement. And there are very few formal links, as I touched on at the beginning, between the Paris Agreement and the TCFD. And in fact, it's possible to do a TCFD report and not actually endorse the Paris Agreement at all. Clearly, it's implied that you should. It's implied that you should have science-based targets. It's implied that you should go beyond and commit to transitioning towards net zero. But none of that's required in the TCFD framework. So there you go, half full. It's really not bad. Half empty, it could be a lot better. And bone dry, it's nowhere near enough, even if delivered perfectly. John, you're on mute.
Thank you, Stephen. I've often used the half full and some of the half empty. I quite like the bone dry. I'm going to use that one in the future as well. Just continuing on, and just perhaps in if you could try and do a quick response on this one. I'm just thinking about, whilst we've seen initiatives started to look at these approaches, and you just picked up on that. Even now, though, and perhaps it's not surprising, the focus is still very much, when we talk about resilience, on climate risk. COVID-19 has clearly demonstrated that there are other major systemic risks out there which is where the UNDRR comes into play as well. But are there any lessons that we ought to be picking out of the last perhaps 2 to 3 years where climate change has become a financial issue? Are there any lessons out of that that we can pick out to try and accelerate the wider discussion on systemic risk and resilience in a whole range of other risk areas?
Thank you, John. Well, one of the lessons is to use opportunities like Sendai and the international discussions like the Convention on Biodiversity, we've got like the COP26 on climate change. So I like the way that Cindy Pitcairn was putting it earlier, where she was talking about the various worlds of economics and finance and politics not really meeting. Now they really should. We need a space where multilateralism meets capitalism systematically, they're each holding the other to account for mobilizing a transition. And I'll come to COP26 in a big way in a second, but if I look at antimicrobial resistance or diversity and exclusion or biodiversity and ecosystems damage, these are all issues that are causing at least pandemic scale challenges to global economic growth and require government action, and isn't the kind of thing by themselves that investors, no matter how sustainable or responsible they are, investors cannot deal with those issues. They are market failures, and we need the governments to correct the market signals so that investors' capital flows in the right direction. You need to, in the jargon, internalize the externalities. So it's really fundamentally important that governments take action that are aligned with good fiscal discipline, costs of carbon that can be internalized into cost of capital. We also need standards and directives, and we need to make sure that the government doesn't just delegate their responsibility to the market to regulate these issues when the market is inherently short-term and discounts the future. And even mega disasters in 3 or 4 decades get discounted to being meaningless when you apply it to a discount cash flow analysis. And that is a stark reality, but it is the tragedy of Horizon. So the way we break through that, and that space where multilateralism meets capitalism, the World Bank had a go at this a few years ago as part of a G20 in Sao Paulo. But what we need is capital raising plans for each of the nationally determined contributions within the Paris Agreement. So every member state that does their nationally determined contribution should also set out what money they need, what investment capital they need, what kinds of investment opportunities there are for inward investment to the market. And we need in turn the market practitioners, particularly the massive systemically important financial institutions. We should collectively set out what is our investment appetite for this kind of adaptation and mitigation investment. We should have institutionally determined contributions that feed into that NDC process, that feed into the COP26 process. And then collectively, both those capital raising plans and those institutionally determined contributions should add up then into a Paris Agreement investment plan. Or if you want to think of it like this, a Marshall Plan for the planet. At the moment, I find it absurd that even the best estimates of how much money is needed for the Paris Agreement can disagree by trillions. They really do. And I find it utterly odd that despite having capital markets that are definitely broad and deep enough to finance the Paris Agreement, no one can tell you who's financing what, when, and why. And I think we need to deal with those issues rapidly. Back to you, John.
Okay, thank you very much, Stephen. That's a very powerful message. I'm going to turn now to Felix. Felix Sendai is the financial sector expert in the Global Financial Stability Analysis Division of the International Monetary Fund's Monetary and Capital Markets Department. He's one of the prime authors of the Global Financial Stability Report on climate change risks and sustainable finance. And previous to that, Felix worked in the Economics Department of the UK's Financial Conduct Authority. So, Felix, I mentioned the Global Financial Stability Report, which focused on the impact of climate change physical risks on equity prices. And I know you've written several other pieces on the connection between climate risk and macroeconomic financial stability. Could you share some of the key lessons from that research on the impact of physical risks on macroeconomic financial stability, and perhaps start to think about where this takes us when we start to consider wider resilience issues that are of particular interest to UNDRR?
Sure. Thanks a lot, John. Yeah, so let me maybe walk you just briefly through the GFSR and what we did there. So in the April 2020 GFSR, we had one chapter on climate change, physical risk, and equity prices, and the starting point here really was that we know climate science is telling us there is an increasingly high degree of confidence that future global warming will imply a greater frequency and severity of hazards, and that these hazards are then a source of physical risk, and that might affect financial stability. And we really think about the effect on financial stability through two channels. First, there is sort of a direct channel. When climatic hazards hit a region which are exposed and vulnerable, they turn into climatic disasters, and that affects households and firms and governments. And the shock can then be submitted to the financial sector through exposure to these economic agents, right? As realizations of underwriting risk, credit risk, market risk. And of course, there could also be direct effects through operational risk. Think of headquarters being flooded and so on. So that's the one channel we have in mind. And then the second channel is a sort of a repricing risk. So thinking about how investors today price future climate change physical risk and the expectations of future climate change physical risk. And the idea is that when investors realize that climatic disasters are becoming more frequent or more severe, they could adjust the pricing today, which can have then implications on financial stability. Since a sharp repricing of risk can have knock-on effects on financial markets. Think about portfolio valuations of funds and fire sale dynamics and so on. So these are the two channels we looked at: the direct impact and the future repricing of risk. What we then did is we first had a backward-looking exercise where we looked at large disasters over the past 50 years and how they impacted equity markets. And we find that there is typically a significant and negative effect when a disaster hits a country on the aggregate equity market. But that effect is relatively modest, around 1%, -1%. So a small or modest but significant effect. And then we looked at the second channel because since disasters are expected to become more frequent, the past, so looking back, might be just a poor way to think about future climatic disasters. What we did is we compared the asset prices across countries. So we did a cross-country study, and we would expect that in countries with high exposures to future climate change physical risk, equity prices should be lower compared to countries with lower future expected physical risk, keeping everything else equal. Doing that in an econometric analysis, we found that there is no differentiation in prices between equity prices in these two different scenarios, right? So there are these long-term, potentially very large downside risks, and they are not priced in today. So there could be a sudden readjustment once investors take these risks into account. So that's roughly what we did. So to summarize again, a modest effect in the past of climatic disasters, but then looking ahead, when climatic disasters will increase, we do not see today a differentiation in equity prices across this climate risk dimension. And that, of course, means that there is a risk of a sudden repricing, and that's potentially a concern for financial stability.
Thank you very much for that, Felix. And I think that risk of financial repricing, that shock to the system, is obviously where the Financial Stability Board originally came from when it set up or instigated the TCFD process, but it's still there, that repricing. just moving on a little bit and thinking about the IMF looking at the bigger picture of risks and stress testing, and that we've already heard with scenarios from Stephen, and the Bank of England has been very prominent with its stress testing work. Perhaps you could share some findings from your exercise about where you see gaps or needs emerging in respect of for the DRR community in the context of stress testing and scenarios. What are those areas that the UNDRR should be engaging on?
Well, so we didn't carry out a specific stress test, but in the GFSR. But of course, the financial sector assessment programs, or FSAPs, that the IMF does typically contain stress tests, and over the past decade, I think 1 in 5 FSAPs actually looked at physical risk, typically related to climate change, often in small island states, in countries vulnerable to climatic disasters, but also when looking at advanced economies with systemically important financial sectors, where stress tests are covered as part of the insurance sector. So they look at the insurance sector. That's one area where the IMF looks at physical risk. An example that we had in the GFSR is the stress test done as part of the FSAP for the Bahamas. It's a country frequently hit by hurricanes with a very large impact on GDP. From a financial sector perspective, in the Bahamas, domestic banks typically require catastrophic risk insurance, and insurance companies are reinsured abroad. So this is a channel that is not too important for financial stability, and that's also something that we found in the GFSR, that having a relatively broad coverage in terms of non-life insurance, that helps a lot mitigating the risks for financial stability from climatic disasters. So that was one of our main key takeaways and recommendations that we had. Yeah, so that, I don't know if that answers your question, but that's roughly what we did.
Yeah, thank you very much, Felix. That's really helpful. I don't want to lose the opportunity to perhaps get back to the speakers generally, but also pick up on some of the questions that we are seeing coming through to us. So I'm going to pick up a couple of the questions and see where we go. There's a question here, and I apologize if I read your name out wrongly. Karka Nirazadzi, who's asked, as we are living in a new, unforeseen and unpredictable risk environment, do we need to change and amend the risk indicators and risk management methodologies and approaches we use? And I'm going to start off, actually, I'll ask you, sir, from a politician's point of view, are you seeing that there is a need to really start to unpick the way we explore risk management from a political process?
Definitely I do. And this is where we would need these stress tests that the earlier speakers referred to, where actually you should have triple materiality in risks. First is, of course, the technological and the financial direct risks, and actually there the environmental aspects should be included. The second layer is, of course, what the climate change, if that would happen, would mean to your business. Let's say forest fires or extreme droughts if you are in that area. But the triple part of it comes to the fact that if we would have a full-blown climate change, it's going to cost tenfold, so according to some estimates, 100-fold as much as the COVID-19 has cost us so far. And we know how hard our economies are already hit now. And so if you sort of project this picture, the scale of the costs tenfold or 100-fold, it clearly says that, okay, this is a massive economic risk that is going to destroy your economy, whether you are a state or whether you are a company. And that leads to the triple materiality, because if you invest your money in anything that exceeds this Paris Agreement 1.5, anything that is fossil bound, that is direct financial hazard and a risk that should be projected in investors like pension funds evaluations when they evaluate whether to put the money on shell or not, and on companies themselves, whether their footprint is tenfold when they produce concrete, or whether it is as effective as possible, or whether the bank is lending the money to fossil-bound sectors, or that matter, the states. And if you look that, sorry for the example, one could say that those economies and countries won't be naming that are very heavily coal and fossil fuel dependent, they are bankrupt. And that should be then the triple materiality reflected, for example, in credit ratings. And for that matter, we need a lot of more research and figures, but there's a lot already out there. We just need a change in our mindsets. And as I referred earlier on, we need this sort of a IFRS of climate-related and other sustainability risks, so that the methodologies are transparent and the figures and outcomes are comparable. And that needs to be in regulation.
Okay, thank you very much, Saba. Felix, Stephen, would you like to, is there any comments from either of you on that?
No, I think Saba addressed it perfectly.
Okay, thank you. Okay, I'm gonna move on. There's another question here, and I'll just see if I can find it. Okay, Gregorio Belonde has asked a question, and really that we got the TCFD approach, which clearly is focused on climate change. Should we be using that same sort of approach to explore other risk areas? And clearly we know there is a natural capital version of the TCFD approach. But Steve, do you see TCFD as providing a bit of a template for other risk areas?
Possibly. I don't think the TCFD, well, in fact, I'm certain the TCFD itself won't expand its scope beyond climate risk. That is its firm mandate. But a lot of the issues mentioned in the question do relate to climate risk. Pandemic, for example, becomes more likely the more vectors of transition there are, more vectors of transfer there are. And as we deplete natural resources and go closer and closer to species that carry these risks, we're increasing the risk to the system. So I just wanted to kind of endorse what Seba said about IFRS accounting. It's really important that we have a proper accounting system, but also step up a level on this. I'm just reminded of the fact that this is an emergency, John, as you said at the beginning, and we need every institution of society, every regulator, every insurance company, every bank, every investment manager to do something about climate change. In fact, to do a lot about it, to manage the risk. I think we need an honest conversation here. I think pricing these social and environmental issues and producing a TCFD framework against each one It will encourage better governance. It will encourage certain companies to look at these issues more. But the honest reality is that unless the risks, the externalities, if you like, appear in the cash flows of the security that we're analysing, unless it actually hits the bottom line, then the markets will continue to ignore it. And I think if an externality is formally ignored in a net present value assessment and a discount cash flow analysis, if it's not on the cash flows, you would ignore it. So internalising the externality is the next step. You don't just need more and more TCFDs or TNFDs, as you mentioned, the Task Force on Nature-Related Financial Disclosure, which isn't an FSB thing, is more of a civil society thing. Yeah. So we do need governments to act. And then we need to recognise this tragedy of horizon that Carney first coined, but applying it to the investment world. Most investment forecasts go out 3 to 5 years if you're lucky, and then assume all things will continue to grow at a mean economic growth rate, whatever the cash flow is that you're looking at. And that then in terms of how you value it, quite a lot of the time, people assume that the institution will continue in perpetuity. And a lot of the valuation comes from that future figure. But the hazards that the Sendai framework is seeking to manage, they're often decades out and ignored by the investors, not necessarily so much by insurers, but ignored by investors because they don't affect the current cash flows. So TCFD is good, but it doesn't change the fundamentals in the real economy. So having more task forces measuring other risks, they will be good, but they're not enough. I guess that is a fairly obvious answer, but John, back to you.
Okay, thank you very much, Steve. I'm just going to make a comment. One of the participants, Inga Relf, has asked a question which is very similar. So I hope, Inga, we picked that up because Steve has particularly mentioned about internalizing the externalities, and you've asked about pricing social and natural capital and etc. So I hope we probably touched on to helping you with that as well. I'm going to just drop down because there's a question perhaps I'd like to put to Felix, and that was about, it's a question to you, Felix, and it's not really to put you on the spot, it's just, I suppose, exploring what role the IMF has. And the question is, again, from Gregorio, who asks about whether, is there a role for IMF in helping to mainstream multi-hazard disaster risk reduction, not just climate change, but this wider issue of resilience, and thinking about the specifics of each country. So when you're working with a particular country on financial regulation and supervision, public financial management, etc., is there a role for an organisation like IMF to be introducing and persuading and cajoling and hand on the shoulder with other countries so that they begin to introduce mainstreaming disaster, mainstreaming resilience into their business as usual approaches?
Right. So I can only really speak here about the Global Financial Stability Report and our analysis. But as you see from what we do, we write these reports. We do this analysis that tries to shed light on the drivers of risk, and that was the April chapter was just a start. There's more analysis which will come out in the future. At the same time, there are the FSUPs, for example, that do look at country-specific risks. We are engaged in various multilateral efforts for fostering the collaboration between institutions and getting improving disclosure, improving risk awareness. So I think we are engaged in this whole space, as the question suggests. So I think I'm probably allowed to agree with the question.
Yeah, no, that's fine, Felix. I think that's a fair enough answer. Sam Acosta has asked a question. He notes that the focus of the webinar is on macroeconomic level. Yes, because that's clearly where it's easier to address some of the responses, I think, in the questions. But the question he asks is, in addressing inequality, and that clearly has been demonstrated as one of the challenges exacerbated by the pandemic, what can the panel say about how we can operationalize things like infratech, financial technology, I suppose insurance technology, and other technology investments, particularly at the community level, as a way in which we develop equality, equitable and sustainable developments, and we build resilience back down at that local level rather than just seeing it as a macroeconomic issue. I'm going to just turn to Sirpa really and just ask, from the European Union's perspective, we've heard a lot about the finance strategy, the green finance strategy, etc. But what about down at that local community level? What can we do in terms of politics to build resilience at that level as well?
Well, first of all, I think that there are three elements. The first one is this budgeting and green budgeting, and having the same sort of a sustainability indicators next to financial indicators on regional and local budgets also. So then these local communities could see that actually improving their environment's conditions and people's welfare, they are doing a positive investments and not only adding expenditure, and vice versa. Sometimes when you save or you put money only on road and cement, you might be ending adding the costs and disfavorable actions. Then again, the second one is, at least in Europe, the public procurement is a vast area. We are using more than 20% of the total EU GDP in public procurements. And if we could put there the sustainability requirement on comply or explain model, so that all what we buy, food, construction, services, clothing, linen would be sustainable. And if not, then you would need to explain why that is not possible. We are too small, we are too poor, we couldn't do it, we didn't have the figures. And then have this kind of a EU and national helping centers to help to facilitate with the calculations how to really figure out what is more and less sustainable. That would have a huge pull effect on markets, and then of course on the quality, what kind of a food and goods and services are provided on local level. Then what really sort of intrigues me is this kind of a city initiative, because the urbanization, as we know, is fastly moving all over the globe, and also slightly slower, but also in Europe. If we could get all the major cities to commit to sustainability in broader context, because we need to go hand in hand with the biodiversity, not climate only, and to make them to commit to transition plan, how these cities would be climate neutral by 2030 and other ways sustainable, and then include what they are going to do on their transportation, what they are going to do in their budgeting, in their how they build or repair their buildings, in their services they provide, and all that. It would actually do the trick. And I think that there's an enormous possibility in cities and in the cooperation between them that we should benefit more. Then there's one comment that I still would like to add, even though it doesn't go directly here, to have the cost of non-action, because I think that this cost of non-action should be looked in regional and urban areas at least. And I'm just wondering, could we have that kind of a next negotiation round of Sendai agreement, where actually the climate, the environmental risks, this triple materiality would be better included, and by that way maybe we could boost them globally better in different institutions, public and private.
Thank you very much, Sirpa, for that. I'm going to draw a close to the questions. There are some other interesting questions. I think we're just running out of time, though, to pick up on all of them. What I'm going to do now is just go back to the panelists and to our leading speaker, Mami, at the start. And I'd just like to give you perhaps 1 minute, very short, just to give you the floor to make some final remarks. What are your key important messages you would like the participants, the listeners, to go away with today? So, Mami, I'm going to start with you.
Thank you, John. Listening to what Sirpa said about the tsunami and the early warning system and how people react to it, I was thinking, well, in 2004 in the Indian Ocean tsunami, a lot of people didn't react to what was coming. It wasn't an early warning system, but they saw that there was something funny happening to the ocean, and they went to look at it instead of running away, and a lot of people died. Now, nobody would do that anymore, right? And there's much more early warning system out there to tell us when we need to take early action. So when it comes to these kind of disasters, it's getting better, but because the climate emergency is something that many things are happening as we talk today in California, in Asia, but we don't see it as an early warning. And that's the problem, isn't it? And do we need to have, and we can't wait for something like the Indian Ocean tsunami to happen, because once that happens in terms of climate emergency, as Mark Carney said, we can't self-isolate ourselves and we are just doomed. The second thing I was just thinking is that I do still hope that, although, you know, it seems a bit not easy, that we can find a way to finance disaster risk reduction. Because of course, you know, climate risk is a large part of the disaster risk, but as John, you yourself said, the systemic risk that we are experiencing now is caused by a biological hazard, there is technological hazard, there's environmental hazard. So what we really do need is the way to finance this. Actually, many developing countries do not have the financial means to even gather the data they need to look at the impact that they are facing from disasters, and they don't have the money to finance their capacity. They can't even make their own national strategy for disaster risk reduction because it's not being financed. So it's a bit of a different argument, I know, but I think that, you know, we do need to pick up this financing for disaster risk reduction debate that is just happening. And I hope that people like Steve Sherpa, who have been so vocal and instrumental in building these things, can also help UNDRR and the wider DRR community in doing this. Thank you.
Thank you, Mami. Sherpa, how would you like to sum up and give that, hopefully, message of hope to everybody as well?
I would say that wonders do happen, and even though that we feel, at least I feel sometimes a bit doomed and gloomed, because it seems that we are speeding full ahead towards the climate change and not seeing it. Actually, I think that this issue is boiling in the minds, as we can see, in private sector, in financial community, in IMF, in UNDRR, in many places. And if we can just join our forces, this rapid change, like a bit like the worldview changed after Copernicus or Galileo, it can happen. And then pretty soon we are going to have the right drivers. This is what I'm trying to concentrate quite a lot nowadays. Drivers on place, and we have the seeds and ideas of them already in financial regulation, impact assessment, international conventions, in local level, whatever that is. And so I'm very hopeful that it's a bit like tearing down the Berlin Wall. You didn't sort of tear it down brick by day during 10 years. It first needed to mature in people's minds, and then the actual change happens very drastically. And so this sort of a increase of information, increase of cooperation, and the great impact from financial community can have a great role to play there. That I very strongly believe. And I really would like to thank once again UNDRR, and especially, of course, Mami Mitsutori, whose cooperation and ideas have benefited, for example, European Parliament's work greatly. And let's make this kind of allies in the future with the capacity, intellectual capacity, what we have. Thank you.
Thank you, Sherpa. Stephen, your platform.
Thanks, John. So I mentioned the need for early warning systems, and there is something now within finance called implied temperature changes. That's the embedded global warming potential within investment portfolios. And we've looked at the London Stock Exchange. It's at 3.8 degrees. When I first learned that, it caused me months of angst, because for those of us that know what 3.8 degrees looks like, that is really very dire. That's the Alps looking like the Atlas Mountains, the Siberian tundra becoming valuable real estate as people move there. There's a huge number of changes. And I was already aware of the 43 trillion figure, that 6 degrees of change could wipe off present value, wipe off the value of the stock market, a third of the manageable assets. And those really weighed on me. And so I think, John, you talked about optimism. And I've worked in the industry for 25 years, the sustainable finance industry. In the last 2 years, I've seen more change than I have in the previous 20. We've now got the more central bank governors working on climate risk than ever before because of the financial stability issues. Got more finance ministers now working on it than ever before. And some finance ministers and governors that really matter, some really big players in that mix. We've also now got incredible broad recognition of the importance of environmental, social and governance issues across the city and many, many other, not just the City of London, but the world's financial centres now. Most of the leaders now recognise that climate change is real and they need to do something about it. So I think that we are poised for something, but the question is what? I think what we need to do is build a plan that mobilises money towards financing the Paris Agreement and the SDGs. The Paris Agreement is our greatest challenge. We need a systematic process for building these capital raising plans for member states and giving them the capacity building that Mami referred to, particularly developing countries, so they can do that. And then requiring all those systemically important financial institutions to set out their investment appetites for these kinds of securities and how are they going to mobilize change. That's where this suggestion that we're making, it's lots of other institutions working with us, but we need an international platform for climate finance. We need the COP26 presidency team to create this platform, close to but not in the UN, working with the IMF, working with the World Bank, working with the whole ecosystem that the UN offers, so that we mobilize money to finance this Paris Agreement. And I know you'll be asking Felix next, and it will be the climate change policy assessments that the IMF does are brilliant. There's only 6 of them that I'm aware of. Wouldn't it be great if it was part of Article 4 surveillance, that every country's climate policy work was part of their agreement? And it's not fair to ask Felix to comment on that. But certainly, the IMF is great. And so there's a lot of the ecosystem that exists now. We just need to structure it into some kind of vision and plan and get on with it at speed. This is an emergency.
Thank you very much, Stephen. Felix, last comment from you.
Yeah, thank you. Thanks a lot for the interesting discussion, and Steve for the prompt. It's a fair question, but I will not be able to answer it.
Of course.
But thinking about financial stability risk, which is what we've been looking at, I think certainly we are still at the very beginning of the journey to really understand the implications that climate change will have for financial stability. It's a huge amount of uncertainty, a huge amount of measurement uncertainty, both from the physical risk side, but also the transition risk side that we didn't talk about today. So I think for us, measurement of risk is clearly an important issue that's only partially resolved through initiatives like the TCFD. It's great to see all the progress that's being made there, but I think we probably will need to understand much better what the exposures are to really both for us or for other institutions, regulators to understand these risks, but probably most importantly for investors, for lenders, for insurers, to be able to price these risks specifically because they are so uncertain, they are so long term. It's really difficult, and it can only be done if there is more information out there and there are better tools available to price these types of risks. So I think that's what's probably one important challenge going forward, one of many.
Okay, thank you very much, Felix, and to Stephen Sherpa and Marmi for those comments. Just leaves me really just to sum up incredibly quickly, because we're 2 minutes over time, I notice, and that is, I've been working on resilience, particularly climate change, since 1992 now, on physical risk. And I echo Stephen's point that, or comment, in the last 2 years, 2 to 3 years, there has been the greatest momentum I've ever seen in that period. And whilst we've had, we're coming up to COP26 and still a long way from actually delivering, the TCFD recommendations have been a game changer. But as as noted, they're not perfect. They are flawed in many ways. I think though, what has always struck me in life generally, it's far harder to make a decision than actually implement the decision. And we agonize over making decisions. We all do it, whether it's buying a house, whatever it is. And that's the space we're in at the moment, agonizing over making decisions. And the reality is that our economic system doesn't price externalities in. That prevents us from doing the correct investment. That prevents us from building resilience. We need all partners playing a role, whether it's politicians, whether it's the regulators, investors, and the public. So we've all got a role to play, but we do have to move very, very quickly on this. So a note of optimism, a note of caution, a call for action. We've got to move on this. It's as simple as that. So thank you very much for all your time. Thank you very much to all the panelists. Thank you to UNDRR, for all the organisation work behind the scenes, the unseen people who are sending me messages left, right and centre. Thank you very much. Thank you to all the participants. I hope you've enjoyed it. Thank you very much.
Thank you, John.
Thank you very much. Take care.
Thank you.
Thanks a lot.